Hello, this is Michele Green, Senior Vice President of National Agency Operations. The topic of wire fraud has been covered at nearly every gathering of settlement professionals for more than 8 years now. There are times that it feels like we've been talking about it so much and for so long, the message just isn't sinking in anymore, and the warnings. It seems this way because we're seeing our agents suffer terrible losses in this area nearly every week. As mortgage payoffs have become the prime target for these crimes, the losses have become devastating to some of our agents. Agents have gone out of business, chosen to leave the business, and experienced many other truly awful, sad outcomes when their businesses are impacted by this crime. Because, folks, there's no ability to purchase insurance for failing to confirm wiring instructions and consequently misdirecting settlement proceeds. A topic discussed in more detail in another presentation, but you can be virtually certain that your E&O policy is not going to cover you for this loss. You cannot purchase insurance or other specific insurance that covers this loss, so losses in this space will fall directly on you and your business. This is not the same conversation as we've had in the past. It's important to realize that both the crime of wire diversion and the messages of warning in the wire diversion space have evolved significantly over these many years we've been talking about it. The funds targeted, the party who is targeted, and vitally our ability to insure ourselves against this loss have changed dramatically over these years. What began all those years ago as a discussion mostly about seller proceeds evolved to include attacks on consumers and buyers and their cash to close, attempts at diversion growing in number, and that has evolved to where we are today. Sellers' proceeds and buyers' proceeds are still enormous targets by volume, but in the last several years, agents have suffered huge and sometimes catastrophic losses associated with misdirected mortgage payoffs, which occur after the wiring instructions embedded into mortgage payoff statements are followed in the ordinary course of a closing. And the frequency of these attempts at misdirection has skyrocketed. So what's happening here? We often talk about wire and cybersecurity as hand-in-hand items, but this is a pretty low-tech crime. As I said, the great majority of closings have as part of them the requirement to satisfy an existing mortgage. Always have. Folks have to discern the amount due and find out where to send the payoff funds and then send them. This is accomplished most often by obtaining a mortgage payoff statement from the lender or the servicer. Most mortgage payoff statements have right on them the instructions about how to make the payment, sometimes by providing wiring instructions, sometimes by providing an address to which to send a check, or sometimes both. Once you've obtained this mortgage payoff statement and put it in your file in anticipation of closing, you might receive an email from the seller or even seller's counsel indicating that they'd like to review the payoff statement. There then will happen a discussion about the need to order perhaps an updated payoff statement, or there's an error in the statement. Maybe they'll say they've made an additional payment, so we have to get a new payoff statement. The seller or seller's counsel then forwards you later what they'll call an updated payoff statement via email, via fax, or courier service. Interestingly, fax is the most common way of the delivery of these updated payoff statements in a fraud scenario. When reviewed, this updated payoff statement may or may not have any substantive financial changes in it, but what has indeed changed are the payment instructions. The wire instructions for the receipt of the payoff by the receiving bank, and probably the removal of the option to pay by check if that option previously existed. Your office then does an out with the old and in with the new on this mortgage payoff statement, and after closing follows the payment instructions in the new updated document, and hundreds of thousands of dollars, if not more, are wired to a fraudster's account, who then moves the money out of the account as quickly as possible to places that it cannot be retrieved from. If there's no protocol in your office to confirm that the wires you've sent are actually received by the intended party, you don't find out about this travesty until it's far too late. All the money is long gone, And when the seller inquires about why their mortgage isn't showing as paid off as it should, that's when you are alerted that there's been a problem. This is a very bad day in your office and for your business when you realize what's occurred, that your escrow account is short hundreds of thousands of dollars for the required payoff to the real lender. And remember, you're almost certainly not insured for this loss. Let that sink in. This nightmare scenario is largely preventable. This is not a high-tech cybercrime. It generally all stems from the seller's email account being hacked, as most of our personal emails that are not secured can easily be. Sometimes it's the seller's counsel who's been hacked, but for the most part, it's the seller. So even when you receive this updated payoff statement from a trusted colleague who is seller's counsel, the damage has already been done, as the seller's counsel has received it from a hacked email account of their client, the seller. So how do you prevent being a victim? Many agents these days have gone back to using only checks for mortgage payoffs along with overnight delivery. I'll tell you, but short of using only checks all the time, what can we do? Listen, many lenders act predictably and consistently in how they accept mortgage payoffs. Most maintain 1, 2, 3, or more large clearinghouse accounts for the receipt of mortgage payoff funds. Many agents and other large settlement companies are setting up repetitive wire transfer features in their escrow software to prevent the use of any wire instructions other than instructions that have previously safely been used before. They then learn how the lenders that they regularly make payoffs to behave in this space, and they create a list of known safe bank accounts to which they've safely wired and use only those account numbers. Pretty easy, right? Pretty low tech. Then, prior to wiring any funds, they confirm that the instructions they're about to use are on their safe wire list that they've created. And if they're not on that safe wire list, they call to confirm the instructions with the lender at a known safe phone number, not the number on the bottom of the payoff statement they're about to use. And if they can't confirm the payoff instructions from their safe list, and they can't confirm via a known safe phone number, then they send a check and they use overnight mail. It's that simple. Create a safe list, confirm against that list, or buy a call to a known safe phone number. And if all else fails, send a check. Create, confirm, check. I mean, honestly, we could talk more about checking to see whether the payment instructions have changed from the first payoff letter that you received to the second, and why would that ever be true? But what if the first payoff statement you receive is from seller's counsel and it's fraudulent? We could also talk about how unwise it would be and how unlikely it would be that one large institutional bank would accept a mortgage payoff at another large institutional bank. That's not logical. But, we could talk about strange times of day of receiving emails and strange fonts and all that. But if you create your safe list, confirm against that list, or via a known safe communication, or send a check, you've likely covered all those details and that can escape your notice and the notice of those who work in your office. Simply never wire money to an account you've never safely wired to without that confirmation. Lock this down in your office and allow no deviation without your personal approval and sign off. There are so many agents who have learned this the hard way, believe me. Is there anything else that can be done in this arena? Perhaps. There are companies in the market today whose business is to provide settlement professionals with verified wire instructions for payoffs. Many agents are moving toward companies like this to help transfer or share the risk. These companies have their own insurance with financially strong carriers, providing coverage of up to $1 million if you utilize their validated wire instructions for wires. It's certainly something to consider. Most agents would buy insurance to protect their business against wire diversion losses if they could, but we've already discussed that we can't. Perhaps the funds that would have been used to purchase insurance could be budgeted toward utilizing the services of companies like these that are financially backed to share this risk. So there you have it. Mortgage payoff fraud is real and it's scary, but it's not unavoidable. Don't be a victim on this. Thank you as always for your time and attention today, and thank you as always for trusting the FNF family of companies with your business. Thank you.